Okay, so we talked in the beginning about treasury stock. That's where a corporation buys its own stock. But why would a corporation do that? Well, one reason would be that if they have an executive stock option plan where the executives, if the profitability reaches a certain level at the end of the year, the executives get a chance to get common stock and they get it at a price that's stated in their contract. Well, if the company doesn't have any stock to give them, then that's a problem. So treasury stock comes to the rescue because the company goes out, buys common stock, and then they have the stock to give to the executives. Number two, to accumulate stock in preparation for a merger or business combination. Well, in a merger, the companies will look at their stock prices and the value of their stock as part of the process of evaluating what each company is bringing to the party. So if a company buys stock, remember, treasury stock takes common stock off the market. And you know that if you have less of something, the price goes up, right? It becomes worth more. So in this case, you're taking stock away from the market, meaning there are fewer shares available, meaning that the shares that are out there are worth more, giving the company a higher value. Number three, to reduce the number of shares outstanding in order to increase earnings per share. As you're doing your group projects, you're going to be working with EPS, earnings per share, and that's where you take the profits for the year, divide them by the outstanding common shares, and it gives you an earnings per share. It's a ratio that investors use to analyze stock and decide whether or not to invest. Well, if you want to increase your earnings per share, if you buy back some of the common stock, you're reducing the outstanding shares. Reducing the outstanding shares, therefore, increases earnings per share. And in number four, a company might want to buy back its stock to raise the price in the market if it's falling. So if the company something happens, the company's stock starts to fall. People don't think that it's a good investment anymore. In order to maintain the stock price, the company will go out and buy shares. Again, if there are fewer shares available, each share that is available is worth a little bit more. So here's what we do with treasury stock. Assume that in year two, Nelson paid $20 per share to buy back 50 shares of the $10 par value stock that it originally issued at a price of $22 a share. I like to use this particular slide for as an example of something that's important to do on an exam. When you read the problem, find out what's in the problem that you need to know. That goes to cardinal rule number one, right? Read the question 3 times. So let's go back. Let's first figure out, we're talking about treasury stock. So what do we need in order to calculate treasury stock? Well, we need first the number of shares that are being purchased, and second, the price that's being paid per share. So it says right there, Nelson paid $20 a share, so there's our price, to buy back 50 shares. So they're buying 50 shares. Do we need to know what the par value is? No. It's not important for this particular calculation. Do we need to know what the price was originally when the stock was issued? No. Again, so the $10 and the $22, if you don't ignore them, will cause you maybe some confusion on an exam. Maybe you're going to look at it and say, well, do I need to use that par value for something? Do I need to use the $22? So make sure that you understand what the information is that you need and forget about the rest. So we bought at $20 a share, we bought 50 shares back. So 50 times 20 is $1,000. We debit treasury stock because treasury stock has a normal debit balance. And we credit cash. We now own 50 shares of stock. And notice, it's a cash outflow in financing activities on the statement of cash flow. So then sometimes the company will decide to reissue that treasury stock. So they're selling it. The things that you need to know there: how many shares are they selling? What did they originally pay for them? And what's the market price today? So the market price today is 25. We paid 20 bucks a share when we bought them. So 30 shares at 25 is 750 bucks. So we debit cash for 750. That's what we're getting paid. Now, to figure out how much to reduce the Treasury stock account, we're going to multiply the 30 shares times the $20 a share that we originally paid to buy them. So 20 times 30 is 600. So that's the credit to Treasury stock. And then there's a credit of $150 to paid in capital in excess of cost of Treasury stock. And of course, we still have 20 shares in-house. Now, the first type of dividend is a cash dividend. That's the one that we're most familiar with. There are three important dates with regards to a cash dividend. First important date is the declaration date, because once a dividend is declared, it must be paid legally. You can't decide next week, we don't have the money, we can't pay it. It's got to be paid. So it gets recorded as a liability. The second important date is the date of record. That's the date that the corporation will go out and see who legally is holding shares of stock. The legal holders of the outstanding shares will be the ones who are eligible to get a dividend. And the third date, obviously, is the date of payment. Assume that on October 15th, year 2, the board of Nelson Incorporated declared a 5% cash dividend on the 100 outstanding shares of its $10 stated value preferred stock. The dividend will be paid to stockholders of record as of November 15th. The cash payment will be made on December 15th. So we have a liability here because it's being declared in October, but it's not paid until December. So what do we have? A 7% cash dividend on the preferred stock. Remember, by the way, that 7%, that's the guaranteed dividend on those preferred shares. So we've got 100 shares at 10 bucks a share, so that's $1,000. 7% of $1,000 is 70 bucks. So we're going to debit dividends for $70 and credit dividends payable for 70 bucks. So we've now recorded the dividend. When it gets paid, we already went through that. When it gets paid, it's simply a debit to dividends payable, credit to cash. And that's where you get the outflow financing activities on the statement of cash flows. So that's a cash dividend. Sometimes companies will give a stock dividend in place of cash. And what a stock dividend does is there's no change in total stockholders' equity, there's no change in par value, and all stockholders retain the same percentage of ownership. So for example, if the company has 100 shares and you have 10 of them, you own 10% of the company. If they do a stock dividend and they give you an additional 10 shares and the total number of shares goes up to 200, you now have 20 shares. There are 200 shares outstanding. 200 divided by 20, you still have a 10% ownership of the company. Assume that Nelson's Incorporated decided to issue a 10% stock dividend on its $20 par value Class B common stock. Because dividends apply to outstanding shares only, and there were 150 outstanding shares of Class B, they're going to issue 10% of 150 or 15 shares of Class B stock. The new shares are distributed when the market value of the stock, again, this is a situation where you need to go out and find out what the market value of those shares is. In this case, 30 bucks. So 15 times 30 is 450. That's the debit to retained earnings. Remember, this isn't This isn't cash. We're reducing retained earnings where we hold the profits of the company, and that's where we're going to take the dividends from. We're going to credit common stock Class B $20 par, $20 times 15 shares, $300. And the difference of $150 goes to paid-in capital in excess of par value, Class B common. And because there's no cash exchanged, there's no effect to the statement of cash flows. Sometimes a corporation will also do something called a stock split. Now, a stock split will reduce the market price. Remember, purchasing stock or a treasury stock increases the price because it reduces the number of shares outstanding. Stock splits increase the number of shares. And actually, Apple did this, I believe it was in 2015. In July, a share of Apple stock was going for $850. Apple thought that was too high, so they did several stock splits, and they got their price down from $850 in July to $150 in September. So here's the way a stock split works. Stock splits replace the existing shares with a greater number of new shares. Any par or stated value of the stock is reduced to reflect the new number of shares. We're going to see how that works. Stock splits have no effect on the dollar amount of assets, liabilities, or stockholders' equity. It's just extra shares. So here's the way a stock split works. Nelson's board of directors declared a 2-for-1 stock split on the 165 outstanding shares of its $20 par value common B stock. So before the split, we've got 165 outstanding shares. The par value of those shares is $20, and the total par value is 165 times 20, or $3,300. So remember, this is a 2-for-1 split, so it's going to double the number of shares. So after the split, there are 330 outstanding shares, but the par value now, instead of being 20, is 10. Because the number of shares increased by double, the par value was cut in half, which left the total par value to be the same. That's the key here. Same total par value, even though we have twice as many shares. The word appropriation means to take. Appropriation of retained earnings describes a situation where the board of directors decides, for one reason or another, that they want to restrict the amount of retained earnings that's available for dividends. Maybe they're planning on doing an expansion of the company, and they don't want to borrow all the money, so they want to use some from internal earnings, from profits. In that case, they're going to do appropriated retained earnings. So we're going to illustrate here, Nelson Incorporated appropriates $1,000 of retained earnings for future expansion. So we debit retained earnings, we're reducing that retained earnings, and we credit appropriated retained earnings. Appropriated retained earnings on the balance sheet means this amount cannot be given out as a dividend. It's not available. So here's our balance sheet. A little more complicated, right? So we've got our preferred shares on top, and then we have each one of the common shares that were issued. Underneath that, we then have the paid-in capital accounts, including that $150 of excess of cost of treasury stock when we resold the treasury stock. So our total paid-in capital is $10,950. We go to the retained earnings section. We have appropriated retained earnings of $1,000, so we can't touch that as far as dividends are concerned. We have unappropriated retained earnings of $9,480. Total is 10,480. And then the last item here, this is that 20 shares of Treasury stock we still are holding on to. We paid $20 a share, so they're worth 400. That reduces the total retained earnings to 21,030. And they're showing here the details of retained earnings. It started at $5,000. We added $6,000 of net income. We're subtracting that cash dividend. Remember, we paid a cash dividend of $70, and we had a stock dividend of $450. So that gave us the ending balance of $10,480. And that's it for chapter 12. Chapter 11.